This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Rory back on the show. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Rory's picture saying, looking for the downloads.
Patrick, Rory had quite a few interesting takes on the market. What's on deck for this week's Trade of the Week?
Eric, coming out of Rory Johnson's interview, the key takeaway for me is that crude oil can look oversupplied on paper, but still trade like as a soft floor because sanctions enforcement and these oil on water bottlenecks keep barrels produced but not fully available to clear in the market. With the market repeatedly respecting the mid to high 50s as a meaningful support zone, I'd rather monetize downside premium with defined risk than try to hero call the direction in a headline-driven tape. So for the trade of the week, I'm looking at a short-dated put credit spread on WTI options. These are the February 17th, 2026 expiry options settling into the March 2026 crude contract with crude oil around $59.80. We sell the $59 put at $2.35 and buy the $55 put for 80 cents. That's a 59 by 55 bull put spread for a $1.55 net credit, or about $1,500 per 1,000 barrel contract. Payoff-wise, you're short downside convexity, long carry with a hard-defined risk. The max profit is a $1.55 credit if WTI settles at or above $59 at expiration. Your break-even is $57.45, and your max loss is $2.45 if WTI settles at or below $55. The max gain versus the max loss doesn't look thrilling if you stare at it in a vacuum, but this is a probability-weighted income trade. Using the options market's implied distribution, you got roughly a 62% implied probability of expiring above break-even and about a 1 in 4 chance of finishing through the $55 strike where you're at a max loss. The bottom line, you're getting paid to take the view that over the next 30 days, that $55 to $60 level acts like the market's floor.
Patrick, every Monday at Big Picture Trading, your webinar explains how retail investors can put on our most recent Trade of the Week. For those listeners that want to explore how to put on these trades in greater detail, don't miss out on a 14-day free trial at bigpicturetrading.com. Now let's dive into the post-game chart deck.
All right, Eric, what are your thoughts here on equities?
Well, Patrick, I put on the S&P hedge that you recommended in last week's Trade of the Week, and I agree with your analysis that you gave then. The trend is very clearly up, but positioning is so crowded that it wouldn't take much to bring on a sharp correction. So I think that protection makes lots of sense up here.
Well, Eric, I want to continue to build on last week's conversation about the underpinning sector rotation that's getting underway. On page 4, I'm showing that chart of the Mag 7 ETF, which has continued to deteriorate as we're having these big mega caps continue to have selling pressure. But the newest development is that the earnings on these financial stocks like JP Morgan and Bank of America have started to come out, and the financial sector ETF has clearly broken to the downside, attempting to derail one of the sectors that has been the leadership over the last few months. So the big question here is that if we are seeing this pressure on the Mag 7s, but the earnings start to create disappointment in some of the leadership spaces, does that leave the window open for a deeper S&P correction? We'll be watching right now the 6850 to 6900 level on the S&P futures is that line in the sand level I'm looking where retracements, so long as they're being bought on pullbacks, then we want to just acknowledge that the bulls remain in control of this trend. But any technical breakdown there could cause many of the CTAs and other systematic traders to begin some sort of a profit-taking cycle that could usher in a first quarter market correction. we'll certainly see how these earnings start to play out over the next few weeks. All right, Eric, let's touch on that US dollar.
We've taken out the 200-day moving average to the upside and are setting up for a golden cross now. So without a doubt, the clear and established downtrend is changing to something else. But as far as I'm concerned, the jury is still out in my mind as to what that something else is, whether it's really a direction change to a new uptrend, or even here at 99 on the Dixie, we're flirting with 99 as I'm recording this. Is it really a trend reversal, or is it just a broader consolidation pattern forming? The reason that I'm not sold on the idea that it's a trend reversal is President Trump's bold geopolitical moves. Let's not use dirty words like regime change or annexation here on the show. Those are definitely dollar-positive, short-term influences. So the question in my mind is whether that recent dollar strength that we're seeing is really a trend change or just a reflection of the geopolitical headlines. And if it's the latter, it's likely to retrace and we're likely to resume the downtrend when and if the president shifts from his usual in-your-face power bluff to actually making a deal, which he almost always seems to do. So let's give this time and see how it plays out. But definitely the downtrend that was strongly in place is giving way to some other pattern. Let's see what it turns out to be.
Well, over the last few weeks, we definitely have seen that US dollar get back above some key moving average. So really, though, we do need to step back and look what the dollar did in the last 6 months. I mean, after a very nasty drop in the first 6 months of 2025, the dollar spent the last 6 months in a tight 3-point trade range. We are still in the middle of that trade range. And so closes above the moving average certainly are early stage signals. There needs to be meaningful bullish follow through for there to be a big upside on the market. But the one thing we want to keep emphasizing, it is very consensus view that the US dollar is going to weaken. And so the pain trade definitely is the US dollar having an up impulse. Will that materialize? This kind of 99 to 99.5 level is the Fibonacci zone. And if it's cleared, it certainly could be the first part of where we see some bullish follow through on there. But at least for now, I'm looking at this 98 to 99.5 as a neutral zone. And I'm not trying to take any strong positioning without a clear trend being established here out of this trade range. All right, Eric, let's take a look at that oil chart.
Well, obviously, we covered the big picture on oil. It was the whole feature interview, so I'm not going to belabor it too much here in the postgame segment. I'll just say briefly that the price whipsaw that we saw on Wednesday afternoon coincided with fresh statements from President Trump that he might not need to interfere militarily in Iran after all. So that's the reason that Rory's prediction came true, that the big upside move that we've seen in crude oil in the last week had more to do with geopolitical headline risk and that geopolitical risk premium than it had to do with any new fundamental trend. So the next move from here will be headline dependent. Clearly, we do have a big enough upside move that, it could have triggered a technical signal that a new uptrend is in play. I'm fading that signal because I think this is headline driven.
I won't disagree that it will be headline dependent, but let's just make some key observations. What we have seen here in the last month is some pretty negative news towards crude oil, but every time we had a down sequence on oil, it was immediately bought on dip. So there's clearly a base and a support line being established technically. Now, while obviously whether or not oil squeezes to like $70+ would certainly need to be headline driven, at least at this moment, it's clear that there's some sort of a base being established. Let's see if that holds over the next few months. All right, Eric, we got to touch here on gold. It's been ripping to new highs. What are your thoughts here?
Well, just as we predicted last week, this past week did in fact see a fresh new all-time high in the gold market, and that activated measured move targets to somewhere between 4,900 and 5,100 to the upside. But a lot of the upside that we've seen in the last week was geopolitical risk premium, and as with the oil market, if the Iran military strike speculation dies down as the president tames down his rhetoric a little bit, we're likely to see a downside retracement, giving back at least part of this upside that we've seen over the last week, which has been quite significant. And to be sure, we're back into overbought territory on the stochastics as well. So if that geopolitical premium evaporates, there's plenty of room for a significant short-term correction before this bull market eventually continues. But I'm convinced that it eventually will.
Well, I have to agree with your upper targets. Mine are just a little bit lower, like 4,800 towards 5,000. But clearly, gold continues to run. We have silver making new highs, platinum and palladium attempting to break again to a fresh new 52-week high. And so these markets are hot, they're running, and there's zero evidence that the wind has been taken out of the sails. So right now, the path of least resistance is higher to some of these upper targets. The one thing I want to note on silver is that we've really entered a parabolic phase where, we're seeing these $5 swings higher on a daily basis. Whenever this type of parabolic move happens, it certainly can go higher here on the short term, but it feels like there's going to be some sort of a blow off. Maybe it happens at the $100 plus level on silver, but there's likely here to be some exhaustion point where silver is going to have a period where it has to settle in the price after such an extraordinary rip on the upside. Now, I wanted to quickly just touch on this copper chart. We're trading at 52-week highs. I've got upper targets around 640, 650 on the upside. We continue to see the copper markets being very well bid. There's no immediate sign that they've topped out. So let's see whether they can finish off these measured moves to the upper targets. All right, Eric, let's touch on uranium and uranium stocks here.
The structural rally in uranium and uranium miners is clearly on. Even the URA ETF, which has lagged the other ETFs because of its high concentration of small modular reactor company names, just barely closed on Wednesday above the 61.8% fib retracement level of its recent correction. That was the last technical signal that I needed to see for confirmation that this move to the upside is on, and it's on strong. Now, the short-term stochastics are still overbought, so we might need to consolidate here a bit longer. But I definitely think that the move is on to considerably higher prices, and I have a very strong confidence at this point that uranium is going to be the big winner, the big trade of 2026. So I have a very heavy concentration of longs with considerable size in this market, and I'm very optimistic about what 2026 will bring. Patrick, before we wrap up this week's show, let's hit that 10-year Treasury note chart.
It's been incredibly quiet. We got our first wave of data, jobs numbers, CPI, PPI, retail sales, and nothing seems to be at least starting any new trend. We remain in a very tight range. There's every opportunity for yields to move in a big way at some point, but right now they stay in this purgatory waiting for some sort of a catalyst to begin the next big repricing. We'll see what that is and when it starts.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.